Let's get more on today's rally. Joining us now, BTIG's Julian Emanuel. Julian, always great to speak with you. You think 2021 is setting up very well for the stock market. What is sort of the context with that good setup?
So the context is, as we've been discussing here, stimulus. Okay, there's going to be stimulus in all likelihood into or maybe just slightly after the election. However, even if there isn't going to be this package, which we do think there will be, the stage is being set for increased government spending next year, we think, regardless of whether there's a blue wave or some other type of outcome. And I just want to set the record straight, actually. We've done a lot of work on the aftermath of elections. And when you've had years such as this year where the stock market has been sort of mixed, along with an economy that has been in a recession, when you go from divided government to united government, whichever way, obviously the presumption is it's going to be a blue wave. The market is up 7 of 8 years with an average gain of 17%. So there's every reason to believe that fiscal policy is going to help guide the market higher next year.
So does fiscal policy, I'll pose the same question to you as I did to Guy, basically. Does fiscal policy, is that greater than, in terms of the impact on the stock market, than the negative potential impact of higher corporate taxes?
We believe so. We believe that when you look at it, particularly coming off a depressed earnings cycle such as we've been in for the last several quarters, the unlocking of potential and the unlocking of confidence. I think one of the things we fail to remember is that during this entire sort of upcycle of the last several months, while the economy is recovering, the jobs picture is recovering, the one thing that has lagged is actually consumer confidence. So to the extent that you get fiscal, and again, a lot of this also rests on some sort of medical progress against the virus, which I believe is the base case, and we view that as a base case as well. You really do set the table once again for the fiscal and these other elements to sort of overrule any tax increases you might see.
Hey, Julian, as it relates to earnings season coming up, hey, it's Tim, by the way, in case you can't see me. Is there any particular sector that you think is well positioned going into this, and how much do you think this market has prepared for earnings? In some sense, going into the second quarter earnings, we got some sense of where we were and where expectations were. I think we're on both sides of the map, and I think a lot of companies pulled a lot of good news forward. Talk to me about that.
So the market really is not prepared for earnings per se, because obviously the macro and the politics and so on has really swamped everything for the last, call it, 45 days. However, going into earnings, if you are able to either A, revise your guidance higher, or in some cases, in fact, just reinstate guidance, you're likely to do pretty well. Now, the stocks that have really worked, again, technology, those types of high flyers, the bar is difficult because their valuations versus expectations for next year are, the valuations are high, the expectations are less high, and an economy that's likely to accelerate is likely to show disproportionate gains for those more cyclical areas. Financials you spoke about, we favor those very substantially, particularly given what the interest rate market is telling us. And the interest rate market, by not moving during the downdraft in September, says long end yields, in our view, are going higher.
You also like healthcare, according to the notes that I have, Julian, and I thought the reasoning behind that was interesting. It's a strategically important sector for the government. What does that mean?
So basically, if you look at it, we've had years really going back to 2015 and 2016 of very adversarial relationship of the government to the healthcare sector. That hasn't diminished entirely, obviously, given the fact that, for one, we're going to hear potentially the ACA being adjudicated in front of the Supreme Court. But the bottom line is that a 5.5 turn discount to the S&P 500 on a valuation basis versus an historical premium average of 1.5 turns, healthcare has priced in all the bad news politically that it possibly can. And at the end of the day, given what we've seen over the last 6 months with the horrid course of the virus and the fact that we're still going to need at least, all of next year to get back to a semblance of normal, it's very clear to us that either a Democrat or a Republican will view the healthcare sector as something that you cannot be adversarial entirely to, that you have to find, workable partnering and relationships.
Right.
We also think that's going to encourage M&A.
Quite a change from the last election, certainly. Julian, thanks. Always good to see you. Julian Emanuel, BTIG. Karen, what we didn't touch on with the blue wave is increased regulation. I'm wondering, in terms of financials, if that is a concern for you, even though we've got what looks like to be a steepening yield curve at this point. If we give something back in terms of regulation, then how does that impact the sector in your view?
I think, to me, the credit issue is the most important thing for the banks. I just want to update you. About 10 days ago, I talked about buying a trading position in banks, as well as my long position. So I'm out of that trading position now. I feel like the easier money has been made. But I'm optimistic to hear bank earnings, because I think the credit issues are going to be less than the market has priced in. But also, I really want to hear about what their view of the economy is. Because we have all these other things that matter, COVID and Fed and stimulus and election uncertainty and all of that. We don't know anything about fundamentals right now, or that isn't moving the market. So I like when fundamentals move the market. That makes more sense to me. So I'm hoping that starting next, I think it's Tuesday, we'll start to return to fundamentals, and I'm long banks going into that.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.